Imagine owning a piece of a company, a slice of a corporate pie, without having to show up for work every day. Welcome to the world of stocks. I'm going to be going through the evolution of stocks all the way back to the 1600s right up until present day. Let's dive into it. So what are stocks? Well, they aren't just slips of paper or digital entries on a screen. They represent your share of business, your claim on the company's assets or earnings. As the company grows, so does your slice. And just like that, you become a part owner of a company. But where did this idea originate from? Before any real stock exchange was built, some companies had their own kind of trading systems that functioned similar to an exchange. In the 1100s, France had the Courtier Exchange. This was a group of men that handled agriculture debts on behalf of banks. These were the very first brokers, since they traded these debts and regulated them all the way back to 900 years ago. So that's quite a long time ago, but now let's go to Venice. And wowzers, when we think of Venice, we imagine love, canals, and maybe even Shakespeare's Merchant of Venice. A city dripping in romance, right? But hold on a sec. Did you know that Venice played a part in early financial markets? Way back in the 1300s, centuries before Shakespeare's tale, merchants in Venice were busy trading bonds. They acted like brokers meeting clients and jotted entries on slates. Then cities nearby hopped on the bandwagon. Then speed up about 200 years and bam! The very first stock exchange appeared in Belgium in 1531. Now here's a curveball. Before this, innkeepers like the famed Van de Boers family in Bruges played a big role in securities. They'd host meetings at the Ter Beurs Inn, or nearby square where folks discussed government, business, and debt. In this gathering, they were known as the Bruges Boers. These early hubs had houses representing different countries. Traders hopped from house to house, dealing in commodities. And get this, no actual stocks were traded in these exchanges. Instead, they dealt in promissory notes and bonds, similar to how we trade in markets today. Moving on to the 1600s, lots of ship owners from different countries sent ships over to the east to trade or take valuable goods and bring them back to their home countries to trade. These were very dangerous trips for many reasons, including turbulent waters. This meant that it was a risk to ship owners as they would stand to lose huge amounts of money if their ship didn't make it back. So to help decrease the risk of losing money, ship owners would seek investors to financially back the boat and crew for that voyage. By doing this, the ship owner was distributing some of the risk and would therefore not lose much if the ship fell victim to one of the many dangers during the trip. And these trips, super risky. Shipwrecks meant big losses, so owners gathered investors to share the ship's cost. This spread out the risk. If the voyage went smoothly, investors got a share of the loot. But investing was a gamble. If a ship sank, so did the money. Wise investors spread their bets across multiple ships. This way, even one successful return made them a profit. A classic case of diversification, not putting all your eggs into one basket. They were taking a portfolio approach. Then a company was formed called the Dutch East India Company. The Dutch East India Company was the world's first publicly traded company in 1602. Instead of investing in each individual ship on different voyages, investors could buy shares in the company, meaning they would get a stake in the whole load of ships instead. This meant the company could charge for more of their shares and therefore had more money for even more ships and even more voyages. To fund their ships, they had a clever idea: sell parts of their companies to investors. They'd get these ownership bits on paper, which was pretty cool, right? I mean, they could keep it, earn ongoing dividends, or sell it to somebody else, maybe even at a profit. Other nations, like Britain with its British East India Company, started using this investment model. In England, without a formal stock exchange, folks traded shares in coffee shops. Can you imagine finding your broker in person to make a deal? These British investors saw fat dividends that could flip shares for more cash. With no rules on share trading, new companies emerged, like the South Seas Company. They sold all shares even before their maiden voyage. They became very successful at that, and so, lo and behold, more companies start appearing as everyone wants to jump on the bandwagon. If this sounds familiar to things like the dot-com bubble or the wave of ICOs just before 2020, that's because it is. Nothing new to see, it would seem. As more companies were established, a lot of these were blind shares as people didn't even really know who they were investing in, but decided to buy them anyway. Ultimately, the South Seas Company flopped and didn't distribute dividends. This triggered England's market crash. The government then halted share insurance until 1825. However, roughly at the same time period across the Atlantic Ocean, we find ourselves on Wall Street, where the New York Stock Exchange was born on May 17, 1792. This grand marketplace became a hub for buying and selling shares, a tradition that continues even to this day. Their principle remains the same. When you're buying a stock, you're essentially buying a piece of a company. Over time, these physical certificates evolved into the digital stocks that we know today. And in the blink of an eye, they became lines of code traded at the speed of light. A new era dawned on Wall Street, an era of digital evolution. The rise of electronic trading signaled a new dawn for the stock market, a dawn that promised accessibility and convenience. No longer was trading confined to the hustle and bustle of the trading floor with internet-based stockbrokers. Anyone with a computer or an internet connection can now buy and sell shares from the comfort of their own home. The stock market threw its doors open to the world, and some of us walked in. More and more people began to invest, lured by the promise of fortune and the thrill of the chase. The world of stocks had truly become a global phenomenon. But the impact of stocks isn't just limited to Wall Street, it's a global phenomenon. From London's bustling trading floors to Tokyo's high-tech stock exchanges, stocks are the lifeblood of economies worldwide. They're the driving force behind the rise of nations, the fuel that powers the engine of global finance. I mean, just think about it for a moment. When you buy a stock, you're not only investing in the company, you're investing in the ingenuity of its people, the productivity of its workers, and the potential of innovation. You're putting your faith in the future, betting on progress, and playing a role in shaping it. It's the world's economic destiny, and not just the fortune of individuals that are transformed by stocks. Entire economies can be uplifted. Emerging markets can be propelled into the world stage as nations can be driven to the forefront of global innovation. So the next time you think about buying stocks, remember, you're not just buying a piece of the company, you're also buying a piece of history and a stake in the future of that company and your future wealth. And hey, give this video a like if you like this content. I'm going to be talking a lot more about investing and the stock market as we enter into the 2024 recession. It'll be a gold mine for those of us that can plan wisely.